Morning. So शुरू करते हैं. So yesterday we covered hedging a portfolio. Okay, I have not written the full this thing. It's hedging of a portfolio with the help of futures. Okay, so question will be on futures. So first of all, what is hedging? We should must understand. So stocks carry two types of risk. We all know company specific risk and market risk. Fine. And company specific risk we eliminate by how? विभूति कैसे eliminate कर सकते हैं? How we can eliminate company specific risk? By what mechanism? Anyone? Please raise your hand and answer. By diversification. By diversification, we are actually left with only the market risk. And market risk is captured by beta, whereas the total risk is captured by standard deviation. Fine. So we are worried only about the beta now because we are in a portfolio. Yeah. So it's like diversification, whether you do in different stocks or different stocks of various countries or India, whatever, or into bonds as well as the stocks. Any else you want to say, or this is what you want to say? Okay. So while company risk can be minimized by diversifying your portfolio, market risk cannot be diversified but has to be hedged. In case if you feel that you need hedging, but if you hedge it, chances are that you're not going to make any money because the risk is going to reward you and you're only riding on market risk, and that also you're trying to hedge under certain circumstances. So how does one measure the market risk? Market risk can be known from beta. We know that. Okay. Beta measures the relationship between the movement of index to the movement of the stock. How the stock moves with relation to the index, or how the index moves with relation to the stock. The beta measures the percentage impact on the stock prices for 1% change in the index. Therefore, for a portfolio whose value goes down by, say, 1.1%, then the index goes down, sorry, by 11%. Therefore, for a portfolio whose value goes down by 11%, then the index goes down by 10, the beta is 1.1. Is that okay? So I'll just repeat there was a little bit. The beta measures the percentage impact on the stock prices for 1% change in the index. Okay. Therefore, for a portfolio whose value goes down by 11%, when the index goes down by 10%, then the beta is 1.1. That means your portfolio is more riskier than the index itself. Okay, fine. Is that okay? When the index increases by 10%, the value of the portfolio also increases by 11% if the beta happens to be 1.1. So this is a general this thing. Now, actually, it may or may not happen in the market because beta is just indicative, okay? Because it is derived of the past historical volatility of your portfolio that, it is likely to play on a long term, but in a short term, it may not play out like that, okay? Fine. The idea is to make beta of your portfolio zero to nullify the losses. So that means you want to, eliminate the beta. Whatever is written, it means you are trying to hedge. Okay. Hedging involves protecting an existing asset position from the future adverse price movements. Okay. So it means protecting an existing asset position from future adverse price movement. Absolutely. So that is what we are going to understand. Okay. So because in certain circumstances you don't want to make either a loss or a gain. You want to remain be there for some time because of very uncertain times prevailing. Okay. So you don't want that your market risk should make you in a profitable or loss position. If it's going to be extreme loss, that's why you hedge. Okay. In case if you think that the market is going to correct heavily in next 1 month time, but you don't want to disturb your portfolio, so then only you hedge yourself. Is that okay? Now, beta is basically, which is given which can be derived by regressing the returns of the market versus the stock. That is, through the statistical measure. So that is quite unreliable because, if you see a lot of sites, each site will have different kind of a beta for the same company. Why? Because, sometime, you're taking daily returns to regress the stock. Sometime you're taking monthly returns, sometime weekly returns, sometime quarterly returns, sometime you're taking 1 year period, sometime taking a 2 year period. So the betas can change. Okay. So there is another method, a mechanism through which you can work out the beta on the fundamentals of the stock, which is called the bottom up approach. We haven't done that, but maybe I'll share a slide. You can always go through that. Okay. But it also involves, the statistical measure is also inbuilt into the mechanism. Okay. But we take averages in that case because averages sanitize the data. Okay. To hedge a position, a market player needs to take an equal and opposite position in the futures market to one held in the cash market. So whatever position you have, In the cash market, you're long, so you have to take a short position in the futures market. Every portfolio has a hidden exposure to the index, which is denoted by its beta. Okay. Assuming you have a portfolio of rupees 1 million, which has a beta of 1.2, you can factor a complete hedge by selling 1.2 million of Nifty futures. Okay, fine. So if you have a portfolio of 1, you multiply the portfolio with the beta. Okay, and yesterday I just made a little bit change. So this was a portfolio multiplied with the beta and then divide by the Nifty lot, you arrive at how many lot size you're going to short. Steps 1, determine the beta of the portfolio. Okay. If the beta of any stock is not known, it is safe to assume it is 1. So in case if you have some stock where you are not getting a beta, then you can just take a figure of 1. Okay. Either you're not saying that it's very volatile or it's less volatile, say it has volatility which is equivalent to the market. That may be just 1% or 2% of your portfolio. Short sell the index in such quantum that the gain on a unit decrease in the index would offset the losses on rest of the portfolio. Okay. This is achieved by multiplying the relative volatility of the portfolio by market value of its holding. Therefore, in the above scenario, we have to short sell 1.2 into 1 million. 1.2 is the beta, multiply the portfolio value, which is 1 million. So that means you have to short worth 1.2 million of Nifty. Okay. Now, let's take an example here. Suppose, there can be if you look at the index can be up by 10% or can be down by 10%, the two columns. And the first column talks about the gain or losses in the portfolio. First, assume the index is up by 10% and you have taken a short position. So your gain in the portfolio will be 1,20,000 on a 1.2 million portfolio, but you will lose in futures. So that means net effect is nil. Even if you have gained in the portfolio, contrarian to the view that the market is going to go down or the stocks are going to fall, but what happened was the market has rebounded, it has not corrected. So in that case, you will still have no money. I mean, not going to make any gain. Though your portfolio has gone up by 1,20,000, but you will not realize that gain till you are playing this short game. Okay. But in case if the index is down by 10%, which you were foreseeing, then you lose in the portfolio, but a corresponding amount you are going to gain in the futures market. So that means in both ways you are going to be totally hedged. Neither you make a gain nor you make a loss. Okay. As we see that portfolio is completely insulated from any losses arising out of a fall in the market movement. But at a cost, one has to forego any gains that arise out of the improvement of the overall sentiment. Is that okay? Then why does one invest in equities if all gains will be offset by losses in the future? Okay, that is only in a special circumstances where you feel that the market is going to fall. The idea is that everyone expects his portfolio to outperform the market irrespective of whether the market goes up or not. His portfolio value should increase. So he wants that his portfolio should increase. So he wants to remain invested rather than exit and selling all the shares in a belief that the market is going to correct. But market can always add his own mind. Sometime, when there is a common consensus the market is going to fall, when the market rises. Okay. Now we are actually in a scenario where we can't say with conformity that the market has gone up, but over the last a couple of weeks the market has been range bound. It has gone down by a couple of percentage points. It's corrected, then every day it's going up and down. So belief is that it may go down because the valuation seems to be very high currently. Okay, and there is some uncertainty which is prevailing because of the elections coming, and of course it is very much on cards that India will return to the power, but still there can be some kind of a thing which can happen. So the market can go down on a kind of a slightly negative news which is there in the political news. So the same methodology can be applied for a single stock by deriving the beta of the script and taking a reverse position in the futures market. So you can do it for individual stock also as well as a portfolio, but this is well designed for the portfolio. Okay, fine.
So the cost point would be the margin money.
The cost involves margin money, interest on margin money.
Interest on margin.
Interest on margin money, number one. And somebody has pointed out there can be an income tax, kind of losses. Gain. You have to pay income tax, but that is not factored. When you are actually, trying to protect your portfolio, you are ready to pay some kind of a tax so that you don't lose the value of the portfolio.
And
Okay.
futures can be exercised any time before the maturity.
Before the expiry, you can even close your position.
Before expiry.
You can when you take a long position or a short position, you can close it before the expiry, or you can roll it over to the next near month also. Okay. So just to look at this question again, now what I have done, I have added one more stock. Like, we have Reliance in the portfolio, we have Maruti, we have DLF, and we have Larsen and Toubro. So this is the weightage of portfolio we have, and the market price is 2,700 for Reliance currently, 9,880 for Maruti, DLF 759, and Larsen Toubro 3,600. So these are the numbers of shares you hold, okay, and that means 40 lakhs in Reliance, Maruti 44 lakhs, 75 lakhs, 90,000 in DLF. Of course, now real estate market is supposed to do well, so that's why he has taken a higher this thing. But those stocks are more riskier. Then Larsen Toubro 54 lakhs, and if you see the beta of Reliance is 1.02, and Maruti it is 0.55, and DLF 1.62. Okay, why DLF has a higher beta? Any reason? Any reason there? Huh? No, no. I am asking you. Yeah, क्या reason है बताइए? Yeah. So what is the business with DLF is there in the real estate? In the real estate. So is it riskier business? Why so? Yeah, if you look at the DLF profit loss account for the last 10 years, you'll find lots ups and downs. There's a lot of volatility in the profits. Sometimes the market is up, sometimes down. So their sales are not very stable. So they keep going up and down. So with the result, their earning per share also keeps changing. Okay, sometimes negative, sometimes positive. So it is quite volatile. If your cash flows are volatile, that means your beta is to be more than 1. So beta is 1.2, 1.62. So then what we do, we calculate the portfolio beta, which is 1.13. Okay, like you have the betas, then you multiply it with the weight of each with the beta, you arrive at the beta of the individual stock in a portfolio, and then simply add them up. Is that okay? So beta portfolio is always the weighted average of the portfolio. Now tell me, is it true also for the standard deviation? If you have standard deviation of each stock, not you, anyone, if you know the standard deviation and you calculate the average standard deviation of their portfolio, will it be the same calculation or will it be different? Have you studied about that? कभी पढ़ा? Because it depends upon, it is not, it is dependent on the correlations of the stock. So there is a different kind of formula. It is simply not the weighted average. Okay, but portfolio, you can simply calculate as a ported this thing. So there is a modern portfolio theory. If you have studied that, so there is a formula which is given where you have to apply that and calculate the beta of the standard deviation of the portfolio. Okay, fine. Now what happens is that Nifty, which is currently trading at 21,955. I just changed the numbers because I just wanted to make it a little simpler. Maybe it's around 21,600. Okay, the lot size is 50. Okay, now the portfolio, first of all, let's go to the portfolio. Portfolio is 2 crore 14 lakhs. I made it 2 crore 41 lakhs. How? I multiplied with a beta. So it is multiplied with the beta. The portfolio multiplied by the beta. So you have now this much, money you have to short by selling futures, Nifty futures. So we have arrived at the number how much you are going to short. Okay. So you have a lot size 50, Nifty value is 21,000 currently. And so the value of Nifty per lot is 10,97,000 based on this value. Okay. Which is basically, 50 multiplied by this. Then you arrived at total lots which you are going to short. So this is basically 2 crore 41 divided by the portfolio, the Nifty value. Okay, fine. So now you have 22, numbers. So I just wanted to make it a round number. Of course, you could have had number either can be more than 22 or less than 22, little less than 22. So it can be in fractions also. In that case, you have to take a position either you are overhedged or underhedged. Okay, so I made it perfect hedge by tinkering with the numbers. But in actual situation, it can be 22.5. So you have to take a short position either in 21 or 20. Okay, depending upon your outlook. So this is exactly equivalent to your portfolio now. So this 2 crore 41 lakhs is ये चल ही नहीं रहा तब से अच्छा अभी